Hello and welcome to 7startup's educational video series. Today we'll talk about fundraising fundamentals. This is what we'll talk about today. We'll start off with the story of your startup, then we'll talk about why VCs are so important, raising money, the valuation, convertibles, the investor ecosystem, meeting investors, negotiating, and the conclusion. It's common for venture capitalists to subscribe to a mantra of backing people, not companies. This is understandable, as the success of a startup depends largely on the capabilities of its founders. But of course, it's a lot harder to objectively evaluate the potential of a human being than that of a specific business plan or technology. To launch a successful startup, you need to first figure out the company narrative and why this will matter in the future. This includes understanding your product, market, and growth opportunities. Once you have a clear understanding, the next step is to map startup investor fit via research, talking to other founders, and using partners such as 7startup with deep investor relationships. Curating a list of potential investors and fine-tuning your pitch is just the first step in the fundraising journey. The right investor will be someone who resonates with your story and is willing to write you a first check. Once an agreement is reached on the valuation and you receive the cash injection, it's time to get back to work on growing the business. Venture capitalists often push founders to set big, hairy, audacious goals. Raising money for a startup is more often than not a necessary evil to fuel growth and expansion. The venture capital industry began with investments such as George Dorial's $70,000 in Digital Equipment Corporation, which turned into $35 million. While it's possible to start a company without outside funding, most startups will raise money. The best time to raise, paradoxically, is when your startup doesn't need funds. Investors see these opportunities as de-risked. In an ideal world, your startup is not desperate to raise and has traction and defensibility, which makes it relatively easier to attract the right investors. Of course, funding is important to achieve your goals on your path to profitability. A clear plan for fund allocation is a prerequisite for investors. Investors want to invest in companies that have a strong team, a compelling product, and a large potential market opportunity. A winning narrative that resonates and showcases the future potential of the company. The best early-stage investors seek outsized returns and are risk-takers. They invest before a startup has achieved significant traction. As a founder, curating a strong story and pitch for your startup and clearly sharing your vision with potential investors and partners will be the difference between securing funding or missing out. Valuation is an important and complex topic. It's important to be aware of the potential risks and pitfalls. A high valuation can make it difficult to attract investors, but a low valuation can lead to over-dilution. Don't over-optimize fundraising, focus on the mechanics of raising money that matches your growth strategy, be it equity, convertibles, or debt. Timing is synonymous with luck. Timing is the single most valuable skill of the modern economy, but we would argue it's the least understood and also the least practiced. How can you practice timing? Start writing down predictions about people, companies, and markets. Check in with the companies you talked with a few years ago. How are they doing? Same with people you met a while back. Start evaluating your predictions. Were they correct? Were they too early or too late? A convertible note allows companies to raise money by selling a promise of equity in the future, rather than actual equity at the time of the investment. It's popular because it's fast, simple, and inexpensive, with an average document length of only 3 to 5 pages. However, it's important to note that convertibles can be difficult to understand in terms of dilution, as the actual dilution that occurs depends on how much money is raised beyond the convertible note. You should read every fundraising document carefully to avoid agreeing to unfavorable terms. A popular alternative to convertible notes is a post-money safe, which is a simpler and more straightforward way of raising money and understanding dilution. Many investors prefer the post-money safe over the pre-money safe because it allows them to easily figure out how much of the company they'll own with their investment. Raising money for a startup can take many forms, including angel investments, venture capital, crowdfunding, and initial coin offerings, ICOs. Angels are typically wealthy individuals who invest their own money in a company they believe in, often because they're passionate about the startup or tech. Venture capitalists are professional investors who invest money on behalf of limited partners. There are also alternative ways of raising money, such as crowdfunding platforms like Kickstarter and AngelList. ICOs are a newer form of fundraising where startups issue digital tokens or coins that can be bought and sold on various cryptocurrency exchanges. While the potential for large amounts of money exists in the ICO market, proceed with caution. Startup fundraising rounds are simple. The initial round of funding is often done with personal funds, even credit cards or investments from friends and family. This is typically referred to as the pre-seed round and is used to get the startup off the ground. In pre-seed rounds, usually, equity is not offered, and instead, a convertible note or SAFE may be used. As the company progresses to seed and Series A, B, C, larger sums of money are raised for equity. For most startups, the final stage of fundraising for a startup is an initial public offering, IPO, where the company goes public and shares are made available for purchase on the stock market. An IPO is the holy grail for some startups, whilst others seek a trade sale exit. This depends on the company's goals, performance, and market conditions. The probability. On average, good plans, people, and businesses succeed only 1 in 10 times. To see why, to consider that there are many components critical to a startup's success. The best companies might have an 80% probability of succeeding at each of them. But even with these odds, the probability of eventual success will be less than 20% because failing to execute any one component can torpedo the entire company. If just one of the variables drops to a 50% probability, the combined chance of success falls to 10%. These odds play out in venture capital portfolios. More than half the companies will at best return only the original investment and at worst be total losses. Given the portfolio approach and the deal structure VCs use, however, only 10% to 20% of the companies funded need to be real winners to achieve the targeted return rate of 3x to 5x. In fact, VC reputations are often built on 1 or 2 good investments. When meeting with investors, do your homework and understand what they've invested in and what they care about. This will put you in a better position to pitch your startup. The simplest way to tell your story is usually the best, and it's helpful to have a quick demo of your product to show. Remember that you're trying to convince the investor that you can actually execute what you're proposing. It's a learning process, so listen to feedback and remain open to adjusting your pitch. The best outcome is an agreement or term sheet, but if that doesn't happen, try to understand whether it's a firm no or if there are next steps you can take to work towards getting funding. Presenting a well-constructed and succinct pitch deck with strong storytelling will always stand you in good stead. Successful negotiations with investors are typically brief and straightforward. However, expect negotiation on the terms of the investment, such as the valuation and the capital deployment strategy. Understanding what the investor cares about is crucial. Different investors have different priorities. For example, angel investors may not want to appear foolish, while VCs may want a certain percentage of ownership. Having a number of interested investors is leverage and can put your startup in a stronger negotiation position. Fundraising is crucial for most startups, but should not derail your core focus on growth. By leaning on experts such as 7startup, mapping your ideal customer profile, ICP, and developing investor relations are the key to success. Don't exaggerate or pretend to know things you don't know, as this will damage the trust investors have placed in you. Be honest and transparent in your communication and tell your story straight without exaggerating. Don't over-optimize the fundraising process and lose sight of the bigger picture. Remember that building a great product and business is the most important thing and fundraising is merely an enabler. Don't forget that fundraising is not the end goal, it's a means to an end. When you do raise money, the cash injection is based on trust and a promise of future success. Use the money wisely and stay focused on building a great product and a sustainable business. To wrap up, a no from an investor is not a reflection of the quality of your startup. It simply means that their vision of the future is different from yours. Don't take it personally and instead focus on improving your pitch and storytelling skills. It's important to remember that predicting the future is difficult, even for investors. Instead of internalizing the rejection, use it as an opportunity to improve and sharpen your pitch.